Every entrepreneurial company owner, everyone who started a company or bought a company, uh, needs a place to operate. And they usually start out in a small place. And then they usually expand by taking a second place and sometimes even a third place. It's organic growth of a business. Company starts manufacturing something and all of a sudden they can't believe it, but business has doubled and they need more space. So it's the growth of their business that drives their search for a larger replacement facility. And when I talk about manufacturers, distributors aren't that different. Distributors are more or less the people that distribute what someone else manufactures. They just happen to be more of the middleman. And they grow the same way because when their customers grow, they say, we need more space. And so the manufacturer ships more to the distributor and the distributor needs to grow. So they usually get a second space or a third space. And then when they can't stand it anymore, they consolidate because the efficiencies of being in one building far exceed the problems that you have when you have three spaces. So it's usually organic growth. Sometimes it's because a company acquires another company and they have to fold the companies in. For some reason, there's a level of equilibrium in the industrial market. I think it's very efficient because it's very public when there's a vacancy, because the building goes on the market and people who build new facilities have figured out how much demand they think there's going to be in the market, and they don't generally overbuild. They generally are very cautious. They build what they think is going to get filled up. And the vacancy rates at the very worst were right around 10% after the big economic problems in 2008 and 2009. They came down steadily. Before that, they were probably 5 or 6%. They went up to about 10. They came down to 9. They came down to 8. Today, we're right around 5 or 6, depending on what kind of market. Different parts of the market have different vacancy rates. So there's always going to be some vacancy because you can't ever have 100% occupancy, or there would never be an open building for somebody to move to. People move out of building A and they move to building B, and there's a vacancy and it has to be backfilled. So the vacancy occurs when someone moves out or when there's a new building built. And it takes time to lease it. So that is a risk in industrial that we just have to live with. There is always the risk of a vacancy period when a tenant leaves. We've been very fortunate because in our case, most of our buildings get filled up very quickly, but I can give you some horror stories. And one of the things that I like to tell our investors is that when you think about what the risk is, it's very simple: vacancy. It usually takes somewhere between 60 days and 180 days to fill up a building after a tenant has moved out. And that is a very difficult period. It's dry. No one's paying the taxes. No one's paying the insurance. No one's paying the utilities. So there is a cost to that.